You know, for so many Canadians, a trust feels like the ultimate way to protect your family's wealth. But what if that safety net had some serious hidden tax traps? Well, today, we're going to dive in and uncover the financial landmines you absolutely need to know about. It sounds completely backwards, right? How is that even possible? Picture this. You've set up a trust for your kids, you move some valuable company shares into it, and you're feeling great about securing their future. But then, the tax bill for all the income those shares are generating lands right on your desk. That's the crazy puzzle we are going to solve today, and trust me, the answer is buried deep inside Canada's tax laws.
All right, so here's our roadmap. We're going to start with the absolute basics, what a trust even is. Then we'll get into something called the three certainties, the legal bedrock of it all. From there, we'll uncover a sneaky, invisible tax event, before hitting the main event, the tax boomerang rule. We'll even touch on what happens when your family goes global, and then we'll wrap it all up with the bottom line.
So, at its heart, what is a trust? It's really just a legal relationship. One person, who we call the settlor, gives assets to another person, the trustee, and their job is to manage those assets for someone else, the beneficiary. You can think of it like a vehicle you build to carry on your legacy. But for that vehicle to actually be roadworthy, it needs a super solid legal foundation. And that legal foundation, it's built on something the law calls the three certainties. Seriously, think of them as three pillars that are totally non-negotiable. If even one of them is a little bit wobbly, the entire trust can just collapse. So let's break down what they are. The three certainties are intention, subject matter, and objects. First, you have to clearly intend to create a real, legally binding trust. You can't just be expressing a hope or a wish. Second, the assets that are going into the trust, the subject matter, have to be spelled out perfectly. And third, the beneficiaries, the objects of the trust, have to be clearly identified so there's no confusion. Let's see just how critical the wording is for that first one, intention. I mean, look at this. The difference between a trust that works and one that fails can literally come down to a handful of words. In a famous legal case, using language like "I hope" or "shot down" because it's just too vague. The courts have a name for this, precatory language. It's just a suggestion, not a command. For a trust to hold up, you need strong, binding language like "I declare" or "shall hold in trust." Words matter, big time. Okay, so let's say you've nailed the three certainties. Your trust is legally solid, you're all set to transfer your assets into it. Well, this is where we hit our first major tax trap. A lot of people just assume that since no money is actually changing hands, there's no tax to worry about. But, the Canada Revenue Agency sees things very, very differently. They see an invisible sale. This is a concept called a deemed disposition. What it means is the tax authorities essentially deem you to have sold the asset for whatever its fair market value is at the very moment you put it in the trust. So if those shares you're transferring have shot up in value over the years, you could suddenly be facing a massive capital gains tax bill, even though you didn't actually sell anything. The takeaway here is huge. Giving property away can be taxed just as if you sold it. And now for the main event, the rule that solves the puzzle from the very beginning. It's a powerful anti-avoidance rule tucked away in subsection 75(2) of the Income Tax Act. I call it the tax boomerang rule, and for good reason. It can make all the income from assets you thought you gave away come flying right back at you on your tax return. To put it as simply as possible, under certain conditions, the CRA can just ignore the trust for tax purposes. They look at the income, they look at the capital gains being generated by the stuff inside the trust, and they attribute it all right back to the person who put the property there in the first place. Yep, that means you. So, what triggers this crazy boomerang effect? Well, the rule kicks in if any of these three very broad conditions are met. If there's even a chance the property could come back to you, if you can control who gets it down the road, or if you have any say in its sale. Boom, the rule applies. And that first condition in particular is an absolute minefield for people who aren't expecting it. And don't just take my word for how wide this net is cast. Look at this. This is directly from the Canada Revenue Agency. The keyword is possibility. Not probability, not likelihood, not certainty, just the tiniest, most remote possibility that the asset could someday revert back to you is enough to trigger the entire rule. Even a standard disaster clause that's in almost every trust could be the tripwire. Okay, so if you thought that was complicated, the complexity really ratchets up a notch when one of your beneficiaries lives outside of Canada. Trusts are a fantastic way to support family members abroad, but a whole new universe of tax rules kicks in the second that money crosses the border. Here's the deal. When a Canadian trust pays out income to a beneficiary who isn't a resident of Canada, the trustee legally has to take on a new role, tax collector for the government. They are required to withhold a chunk of that payment and send it straight to the CRA. This isn't optional, and it's due right away.
And what's the withholding rate? A hefty 25%. Now, some tax treaties can lower this rate, but the default, the starting point, is that a full quarter of the payout goes straight to the government. That is a massive cash flow issue that you have to plan for perfectly.
Look, I know. After hearing about deemed dispositions, boomerang rules, and withholding taxes, it's really easy to feel overwhelmed, maybe even a little panicked. But the point of this explainer isn't to scare you away from using trusts. It's the opposite. It's to empower you with the right knowledge so you can navigate these rules and use trusts effectively.
So let's just recap the big takeaways. 1. Trusts are incredibly powerful, but they absolutely demand meticulous, professional planning. 2. The 3 certainties are the bedrock, non-negotiable. 3. Always be aware of invisible tax events like deemed dispositions. 4. The tax boomerang rule is way broader than you think and can be triggered by just a remote possibility. And finally, 5. If you've got non-resident beneficiaries, a whole other layer of complex rules gets piled on top.
Which really leaves us all with one final question to think about. Is the trust you have, or the one you're thinking about setting up, truly a safety net for your family? Or could it be an accidental and very expensive tax trap? The difference between those two outcomes? It all comes down to careful, expert planning.